Okay, we're going to cover habits and expectations today. We're going to get into some pretty nitty-gritty stuff, and I'm going to draw on two main sources, which I'll give references to at all times. Before we do that, we're going to restate what we're trying to achieve, what our objectives are, talk a bit about understanding habits. And it's just amazing how other sources that have come to, really through science and through research, to the same conclusions and same methods that Mark Douglas came to purely through the trading environment. And when you think about it, there shouldn't be any surprise about it, because it is how human beings operate. It's how the process that we go through to learn for the particular environments in which we operate. We're going to talk a lot about expectations and being right today, and that's really going to be the juicy bit. And we're going to introduce the 5 fundamental truths and the role that they play in achieving the mindset that we need to achieve to really be consistently successful and peaceful active investors for the rest of our lives. And then I'll give you some homework and reading to do as well. I'm at peace with all outcomes and all market conditions, and I'm on track to achieve my long-term growth and profit goals, which is the performance part, the performance subset, if you like, to being peaceful and successful. So successful has a profit, if you like, a performance side of it, a dollar performance, and a mindset performance. You have to achieve both, not just the one. So now I'm going to just quote, I've been through my notes, found some quotes that came from Mark Douglas in defining what at peace with an outcome is. That's you won't find in his book or anywhere on the internet. And this is what I took in my notes when he said, is that nothing inside of you that disagrees with an outcome. That's when you're at peace with an outcome. Or absolutely no conflicting thoughts about the outcome when you have an outcome. Then you truly are at peace with any outcome. No conflicting thoughts and no disagreement inside you. So how hard is it to change our outcomes? Now, James Clear talks about this process and he defines it, and it's backed up by scientific research. And he gives lots of references to other books and experiments that have happened over time, where he talks about these 4 stages being cue, craving, response, and reward, or they've got to occur in that order. So he's going to unpack that a little bit, because this really is very relevant to the process that we're going to take you through, the exercises and drills we're going to get you to do, but also to positioning the information that we're going to talk about today of expectations and projecting into the future the need to be right, which is really what our current thinking is if we are unsuccessful in the market, and how we want to break that nexus. So let's just understand a bit about how our habits form, or beliefs, if we interchange the two words. Your brain is a reward detector and predictor as well. That's a brackets added by me, because he does say that we are trying to predict all the time. The cues are about predicting and obviously means by definition into the future, not now, but we're going to get a reward that's going to come down the track. So our brain is a reward detector. As you go about your life, your sensory nervous system is continuously monitoring which actions satisfy your desires and deliver pleasure, so we can feel good, so we can get those dopamine hits. And the point here is that these are going on all the time. Like every nanosecond, our sensory nervous system is doing this, looking for actions to satisfy our desires and deliver pleasure. Feelings of pleasure and disappointment are part of the feedback mechanism that helps your brain distinguish useful actions from useful ones. So we've got this feedback mechanism that's going, gee, that's good, gee, that's bad, by the definition of how our brain distinguishes, and our brain distinguishes through how it currently thinks, how it's currently programmed based on where we've come from over our entire walk in life to date. And Mark Douglas talks about how we are all unique based on the path, the journey we've taken to date. Rewards close the feedback loop and complete the habit cycle. Now, obviously, a habit is a belief that becomes instilled, and you continue to do that, so that habit becomes something you do into the future. If a behavior is insufficient in any of the 4 stages, it will not become a habit, so you won't continue to do it into the future. Eliminate the cue and your habit will never start. Reduce the craving and you won't experience enough motivation to act. Make the behavior difficult and you won't be able to do it. And if the reward fails to satisfy your desire, then you'll have no reason to do it again in the future. Ringing any bells with respect to trading, active investing in the market? Without the first 3 steps, a behavior will not occur. Without all 4, a behavior will not be repeated. So we stop doing it. It becomes too hard and too painful for us to continue doing. So it simply doesn't become a habit. If it doesn't become a habit, it doesn't become a belief, and we just stay where we are. We make no progress. We don't go forward. and nothing stands still. If you're not going forward, you're going backwards. You're getting worse, and you'll continue to get worse in that particular area that you're wanting to develop and improve on. So James Clear talks about the habit loop, and it's 4 stages as described in what we've just gone through, and they form an endless cycle that is running every moment you are alive. We are not in control of this. This is autonomic. It's part of who we are, right? The habit loop is continuously scanning the environment, predicting what will happen next, trying out different responses, trial and error, and learning from the results. And if the results we get back form disappointment and we don't like them, well, then we're not going to do it. So we have to put some effort and work and discipline into the environment that we want to become better at, if we have to persevere, if we want to get better and improve our results. How hard is it to change our outcomes? Well, let's go back to Mark Douglas now, and I'm finished with the James Clear section, is that when we project our beliefs onto some future moment, as an expectation, we naturally expect to be right. What James Clear has just been talking about here is that the cues we're looking for all the time, which is a signal, say, from the market. If we're trading subjectively, then we're looking at charts all the time, and something will recognize us as an indication that there might be an edge present with our subjective analysis, is that the moment we see that as a cue, we are thinking reward predicted into the future. If you're a subjective trader, if you're a mechanical trader and you haven't yet got the mindset that's needed, you'll be doing exactly the same. You'll be going, here's an entry signal. My expectation now into a future moment is that I will naturally expect to be right. And I've got a bullet point for it later, but at the conscious level, what you'll be saying to me now, that's rubbish. I don't expect to be right, but it's not the conscious level we're dealing with here. We're dealing with the subconscious level. This is at the belief level. At the belief level, you're going to expect to be right, and that's what we've got to deal with. The instant you either decide or assume what's going to happen next, you will automatically expect to be right. So this is this connection with an expectation into the future. Now we're getting into the expectations part of today's session. So what is the path to change, to go through that transformation, which is the craving that James Clear talks about in stage 2 of the 4 stages? We can't solve the problem of our minds automatically predicting and automatically expecting to be right, because that's what's happening. That's what James Clear has just told us in the research that he's come out with, which is based on scientific research and his own experiences and research he's done, going through his life and other people he's interviewed and spoken to. So we can't solve the problem of our minds automatically predicting and automatically expecting to be right with better analysis. It just can't happen, because the analysis will never give you a 100% right outcome all the time. It just cannot happen. And we're going to unpack why that can't happen, which will be obvious to you. But to follow through the process so you can understand at a subconscious level what's actually going on in your head and what it is in your mind and what it is you got to fix and what you got to try and transform and become better at and develop at, is this material you really have to assimilate into your conscious mind first before you can actually step into and really believe and have the desire to step into the process that you've got to step into to get to where you want to get as an active investor. So when we're not right, we get disappointed. This is the feedback loop, the habit loop. We compound not being right with mistakes to make it right. Sound familiar? Our expectations are aligned with how we currently think, not with how the market flows. So the market is this object, if you like, that is just flowing. It's doing what it's doing. It's got up and down bars, it's got ticks, it's got up and down weekly bars, candlesticks, all the sorts of ways that we see what's happening with the market. And we see what's happening in the market, how it's flowing through the price action that goes on a minute by minute, or tick by tick, minute by minute, 5 minute by 5 minute, quarter hour by quarter hour, et cetera, to daily, weekly, monthly, all the time. That's the market flowing. And in different time frames, there are different upticks and downticks and up bars and down bars going on all the time. And that flow is just a continuous stream, a continuous flow of opportunities that are being communicated to us through price action. But what we're doing is we see ourselves, our minds are outside of that environment, and we are thinking with the whole bunch of beliefs that have come to us, not from the market, but from how we've lived our lives to date. So our expectations being aligned with how we currently think are not aligned with how the market flows and how the market thinks and how the market acts and how it operates. So we want to get those in sync. So hopefully you all did your homework and you read chapter 7 or the parts of chapter 7 that we gave you last week. So just want to make the point that the act of trading is easy. It's just about putting on trades. That's not a difficult thing to do. You don't need a massive amount of intellect to do that. But the craft of trading is very difficult. And the idea that this is not, you don't solve this by time and intellect. By just spending lots and lots of time and being very, very smart doesn't solve this problem. The way you solve the problem of being aligned, of getting into line with the market flow and stepping from this side and being empathetic and stepping onto that side and being with the market and thinking the way that the market thinks is one of going through a process of actually training your mind to think in a totally different way, the way that it's grown up to think, if you like, through our paths and our journeys. And you got to take some intentional, specific action and exercise to reprogram, to transform the way you think, so that craft of trading becomes easy. And I'll give you some more quotes from other experienced traders on Thursday about that. So we want to make the act easy, but also make the craft easy. And for it to be easy, as James Clear said, we're not going to do this unless we make it easy, unless it becomes peaceful and calm, and we get dopamine hits from going through whatever happens in the market, up or down, regardless of the conditions, all the market conditions, especially the adverse conditions. Trading is hard because we have to operate in a state of not having to know. How can you expect to be right and not know at the same time? When you try to know, you're in a sense trying to be right. And we automatically want to know what's going to happen. Why? Because we're looking for this reward, this craving that the cue got us to take some action, a thought or an action to do. And the moment we do and we act, we are wanting to know. And by wanting to know, we are wanting to be right. How can and be right when uncertainty exists? So we know in our conscious mind that there's uncertainty. I don't think anybody disagreed with that quote out of that psychology book. And it's quite a big, thick book. But how can you know right? But we know that we've got to operate out of not knowing. But I've just said to you that by going through the normal process that our habits and beliefs, our current beliefs go through, is that the moment you get a cue to perform something which comes out of a craving, we're going to automatically expect to be right. But how can you do that in an uncertain environment, which you all agree with is what happens in the market? So immediately we've got our current beliefs are wanting to know, are expecting to be right, but we know that we're in an uncertain environment. Immediately we have a conflict. There's a conflict right there and then that we have to resolve, and we don't resolve that by doing better analysis, fundamental, technical, reversion to the mean, intraday, long-term, whatever it is. It will not solve the problem. We have to solve the problem in the way that we think, so that we can get rid of this mental clash and conflict that's going on in our heads. To operate in a state of not having to know, you have to properly manage your expectations. To properly manage your expectations, you must realign your mental environment so that you believe without a shadow of a doubt in the 5 fundamental truths. So now we're going to go into the material that Mark goes into, and what he's established, these 5 fundamental truths, if you like, beliefs, that if you can make habitual and saying them to yourself so that you believe them at the subconscious level, and so you have no shadow of doubt about these 5 fundamental truths, then what it will do is it will realign it'll energize new beliefs, which are the 5 fundamental truths, but at the same time, it'll start de-energizing the current beliefs that you have, which are dysfunctional with respect to how you've got to operate in the market. So you get both happening. And this is how you realign your mental environment. And this is the exercise we've got to start taking you through. Profitability is an outcome. It's an expectation. So when we're thinking profitability, are we thinking profit, or are we thinking wins? We are automatically, which is an outcome, we have an expectation to the future. The more we focus on profit and money and outcomes, the less likely it will be achieved. Why? Because it's an expectation which demands to be right. And that is outcome-orientated thinking, which we spoke about last week. And the moment you have outcome-orientated thinking about profit then we will not be right because we have this negative feedback coming from the market all the time. And then our mind will automatically take us out of the process. This will be beliefs that we have no control over. We'll either cease doing this or we'll make mistakes. But effectively what we're going to do is there's going to be too much emotional pain, which our automatic pain avoidance mechanisms will try to avoid. So we can't be projecting into the future about profitability or outcomes. We've developed over the millennia to be able to have a set of beliefs and thoughts, each individually and unique, as to how we respond to those environments. But we are now operating in an environment of the stock market. So in the stock market, where does the threat of pain come from? Because the market doesn't purposely provide a data that threatens to make us feel emotional pain. It doesn't threaten pain. We live in environments, an everyday environment, where we do get threats of pain, mentally and potentially physically as well. And we know how to deal with that. It's pretty obvious to us at the time that that pain is coming from the environment, not from us. But there are certainly line ball situations where the environment's not giving us pain, that we perceive it as pain as well, and vice versa. But the market at no time threatens pain at all. All it's doing is providing us this flow of opportunities. And it sees that it's giving us opportunities in different time frames and different ways and in different patterns and all sorts of things. So that's its perspective, is that it's just this flow in the moment of neutral data coming our way. So if the market is not purposely giving us pain, or data that's threatening pain, then it can only be us interpreting the data as threatening to cause pain. And it can only threaten us to cause pain if we predict into the future that there's going to be some pain come out of this. Because if we were truly in the moment and we were neutral in our thinking, then there would be no expectation to the future, and we would have a neutral expectation, which is nothing, just that something is going to happen. So we interpret data based on what we believe to know, think and feel to be true. So if whatever our truth is, whatever our individual truth is, it's unique to us, but it's also our identity. Our beliefs are who we are. Mark Douglas uses the word beliefs, whereas James Clear, he uses the word identity, and identity effectively is you made up of a whole bunch of beliefs. So we are all unique. But if we're interpreting data based on what we believe to know, is what we know all encompassing? Is all that we think all encompassing? Is all that we feel true? So we project our beliefs, our unique beliefs, into the future as an expectation. We expect projections in the future to be right because they are based on what we believe to be true. And what I believe to be true and what somebody else believes to be true are different. And I'd put to you that what I believe to be true about the market and the data that it gives me, and this is my personal beliefs, would be different to those people who have not yet assimilated the type of learning and skills that Mark Douglas talks about, but not only Mark Douglas, James Clear, and even psychology books, right? So our beliefs with respect to the market would be different. What I believe to be true about the market would be different to somebody else's who's not successful in the market. I would challenge you to be able to take a big chunk of their money and trade it in the public eye with all their foibles and all their beliefs as they currently stand. Now, I can do that because my beliefs are very different to that person's. So we are different. And what we do is we project into the future. So what we expect, we project into the future, and it's based on what we believe to be true now. And any data that does not confirm we are right automatically becomes threatening to cause pain. So any data that we project, if we take a position and suddenly the market starts going down because we are projecting to the future, we're wanting a reward that satisfies us or teaches us, it's going down. Therefore, it's become threatening to us because we are interpreting that data and we are taking the cue of the going down, we are projecting that into the future as a craving, and we are looking for a positive reward, which we now perceive projecting into the future is not going to happen because it's not proving that we are right, which we are wanting to happen based on what we believe. So that causes us pain. And when we feel pain or perceive that we might feel pain, our pain avoidance mechanisms block, distort, diminish the significance of any data that threatens us. So suddenly we get taken out of the flow. And then this is when we start making mistakes. And the mistakes we're going to get into defining in a future session. But effectively, we take ourselves out of the flow by not executing our edge the way that it should be, executing our rules the way we should be. So let's take this scenario. With no money at stake, when simply observing a price chart or reading a newsletter or listening to geopolitical events, So you've got no money at stake and you're simply just looking at a price chart or you're reading some information or writing or reports or about the stock market, or you might be reading the newspaper or something. And the whole time your mind is automatically every nanosecond looking for cues as to how whatever you're taking in is going to affect your craving, which is the desire of you being profitable. And it's taking all this in all the time, right? And if you have no stake, and you don't have any money on the line, if you like, do any of the ups and downs, bars or noise make us feel disappointed, despair, or frustrated? So you're in a neutral mindset now. You've got nothing on the line. You've got no stake. You've got nothing that's going to affect your profitability. You've got nothing to lose. Any negative feelings then when you're just no money at stake? The goal of making more money and profits isn't threatened. So you don't have any feelings of despair, disappointment, and frustration. With nothing at stake, there's no expectation to be right or wrong in the future. We're just looking at it with a neutral mindset because we haven't projected into the future what we believe we think we know is true as an expectation. We are just taking in the information. So there's no pain to avoid. So no up and down data on the chart that could potentially threaten us, because there's nothing to threaten. We haven't got a projection into the future as an expectation to be right because we've got no money at stake. So pain avoidance mechanisms aren't automatically enacted to distort or diminish the data to protect us from any pain. So we are just neutral. So to have a stake, we have to neutralize our expectations. We have to get ourselves into that same frame of mind as if we have no stake. We have to be carefree. We have to be peaceful about it. We have to be calm, cool, and collected. So we have to be like the market. Believe all data is neutral. And we need to be willing to think from the market's perspective and be neutral. So early on, I was just saying that to get into, we're on this side, we're operating out of our current belief systems. If they haven't been, and some of you would have, your belief systems would have been, the listening to this would have been transformed into thinking like this. And we've had emails from people saying, oh yeah, I've got this. Why are you going over this again? But we're all at different stages of the journey. And this is material that you can go over and over again whenever you get stuck, to really understand what's going on in your mind so that you can transform to a different way of thinking. So we want to get from being over here, operating out of beliefs that are consistent with how we have come through our walks of life, to operate in society with that societal paradigm. And we have to become empathetic with the market, hop the fence, and start taking on a market paradigm and to think from the market's perspective. And the first step of that is of the market being the market's perspective, is that it's neutral. It's not, all it's doing from its perspective is giving you an endless stream of opportunities through price action. And it's not trying to hurt you. We're only perceiving that hurt. So we have to get into that neutral mindset and not perceive hurt or emotional pain. And the market's perspective is to operate in probabilities, not certainties. Now, at a rational, conscious level of our minds, we'll go, we know that the market is not giving us certainties. We understand that it comes in probabilities at the conscious level. But until you resolve this at the subconscious level, at the belief level, your belief system is going to do your bidding for you, not your conscious mind do your bidding for you. It's very hard, and Daniel Kahneman talks about this as system 1 and system 2 minds, which we'll introduce in some other sessions coming along, is that we have to get this operating at the belief level, right? At the level that's automatic, so it doesn't, otherwise it's automatically going to try and avoid the pain. So we have to get onto the operating in probabilities and think in terms of probabilities, and then our belief system will become more aligned with how the market operates. Now, probabilistic environments are everywhere. In fact, can you think of a certainty environment anywhere on the planet? Even taxes aren't certain. A constant flow of known and unknown variables creates a probabilistic environment where you don't know for certain what will happen next. You might understand that at the conscious level, but you have to get to a level where that is just part of who you are. It's part of your identity. It's a belief that we are in a constant flow of known and unknown variables, and it's a probabilistic environment, and we don't know what will happen next. To think from the market's perspective, to be neutral, you have to learn to think in probabilities, which clashes with our belief of what is true, because projected into the future is an expectation of what we believe is true, is an expectation to be right, i.e. certain. That's what's happening at the subconscious belief level. We have an expectation to be right the moment we project into the future, and right equals certain. So here we are operating in a probabilistic environment, which is an environment of uncertainty where we don't know what will happen next. But at the same time, we have a belief structure that the moment we do something, the moment we take something that could potentially hurt us, we expect to be right. So we've got certain versus uncertainty clashing all the time unless we can resolve this at the level of our beliefs. At a conscious level, we accept that our expectations can't be certain. We know that, and I'm sure you're all sitting there saying that. But at a belief level, the data threatens emotional pain because it hasn't got to really assimilate truly what uncertainty is. It doesn't accept that because why? Because it's going from its beliefs, and once its beliefs to, as James Clear said, is that we have an expectation into the future. We want to be right. We're looking for this reward that satisfies us, which causes us to avoid the emotional pain in case it happens. Manifesting as repeatedly making trading mistakes and trading errors, which we went through last week, what those are, and I'll go through them again next week as well, and we'll get into the reframing, the redefinition of what is right. So to think in probabilities, you have to create a mental framework or mindset that is consistent with the underlying principles of a probabilistic environment. A probabilistic mindset pertaining to trading consists of 5 fundamental truths. And so this is what Mark is doing now. He's come up with 5 fundamental truths that if we get these, or truths, if we get these truths, if we instill them at the belief level, then it's going to solve the problems of how we currently think. We're going to energize a set of new truths, which are going to de-energize the old truths, if you like, the old beliefs, the parts of our identity that make us random and inconsistent and taking signals at the wrong time, not letting our profits run, not cutting our losses, all those sorts of things that happen are the mistakes. And then we compound those. And not only do we make them many times, we just in fact never sell things that keep on going down, and we take small profits. There are instances of people having 60% win rates that lose a lot of money. Why? Because the 40% of trades that they lose on, they just let them keep on running in the wrong direction. But the profit trades, they take small profits. So they're cutting their profits and letting their losers run, but they have a high win rate. Why? Because they want to be right. So let's go into the 5 fundamental truths. So I'm not going to go into these into detail because effectively I'm just going to state them, but a lot of you will know what they are, and you should be able to say these verbatim. And I'll say them to you now verbatim before I put them up there. Anything can happen. We don't need to know what's going to happen next in order to make money. There's a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of a high probability of one thing happening over another, and every moment in the market is unique. Now, I learned those verbatim off by heart about coming up for 20 years ago. And that's something that we're going to get you to do when you do trades in the exercises we're coming up to. Homework for this session. Read chapter 7 in Trading in the Zone. Now, the last set of homework I gave you just to read the managing expectations section, which got into the 5 fundamental truths. I've also unpacked, so that reading I gave you first, but I unpacked the first part of chapter 7 and some other parts, and obviously James Clear's work, but also some other parts of Trading in the Zone as well. But now I want you to read the whole chapter. So read it in the sequence that Mark actually wrote it, and hopefully it'll make a lot of sense to you now after you've gone through the session. There the page numbers are in the hard copy and Kindle. And I also want you now to go and read part of chapter 11. It's a different part. This is in preparation for the next session. It's a different part of chapter 11 to what I gave you in one of the previous sessions. It's page 184 to page 193. And here we're going to get into the 7 principles of consistency.